Well, there we go. Welcome to our webinar today. And yeah, it's another week. And today we're discussing, does the RAND concern you? This is a show of hands quickly. If you can just participate. Who is worried about hands? Okay, we've got some hands going up. Awesome. Okay. So there's quite a few worried about the RAND. Okay. Okay, like we do with every webinar, I see some of you guys have got questions already. Just type in the question box if you've got any questions, and hopefully by the end of the presentation, I would have answered it. But please, in the same box where you typed in the sound check, that's where you would type in the questions you might have. So that's the first question. Quite a few are concerned about the, thank you, okay, let me put the hands down, about the RAND. So the second question is, how many of you do not like market volatility? Just show of hands quickly. Do not like market volatility. Like a bit of a trick question. Okay, so none of you guys got hands up. Okay, that's cool. So all of you like volatility. Okay, good. Because that is, as I say, a bit of a trick question. Volatility is the name of the game, especially if you're a trader. So here's a quote about volatility, and I think it's leading to the presentation. Volatility may be rising simply because investors or traders must digest more information every day. And I think those of you that have been following the news the last few weeks, even the last few months, will realize there's a lot of news events that's been moving the markets. Okay, and so you can say some of those news events have been shocks. Okay, so we talk about more information. Sometimes we might say we might have information overload, but not everyone gets the information at the same time. Number one, obviously, you might not have been aware of it, and secondly, obviously, you might not have access to that information straight away. So there's always a delayed reaction, number one. Sometimes there's an overreaction, but there's also different opinions, and that's what makes the market so interesting. So what I'm going to do today, if I were to bring in my quick agenda, my objective today, my overall message, to take advantage of the news. Okay, so I want to create awareness that you can take advantage of the RAND volatility. You can do something about it. You can always plan better. So that is my main objective today. But also for you to provide options to you, so you can make better informed trading or investment decisions, and ultimately you as an investor or trader can have that peace of mind. So, okay, so let's get into the nitty-gritties. What is the current situation for a lot of people? And I'm going to use what's been happening on the market or what's been in the news the last few days. We could talk about Friday, and this whole run-up to the Standard & Poor's global ratings. On Friday night, everybody did not know what was happening. It was a 50-50 call. But what happened is that S&P, they left South Africa's sovereign credit rating unchanged, okay, which was good. And we saw the reaction from that is it's boosted the RAND, number one. And number two, obviously, the sentiment is a bit more positive. But saying that, they did flag, number one, South Africa's politics as a key concern. However, obviously, weak economic growth, the outlook is that still a big concern to them. So going forward now, the pressure is on South Africa, obviously, to sort itself out, both politically and economically. With this big thing now politically, we've seen what happened with Nannygate in December. Excuse me, the Constitutional Court ruling on President Jacob Zuma, and also we've seen what's happening with the disputes, the periodic disputes between key government institutions, and obviously the ruling ANC. But that is the current situation. And the transfer one step further, you can look at this is what happened this is on Friday. That was on if I bring in my cursor here, okay, my spotlight. That breakout below that support level, that was on Monday. Okay, so and since then you can see how the market has reacted. The RAND is getting stronger. This is looking at the RAND relative to the dollar. So when the chart goes up, it means it's RAND weakness. We have to spend more rands to buy $1. So yeah, top here we're talking about 17 rand to the dollar. We pulled right back. So if I had to look at way back a year ago, can you believe a year ago we were around about 11.50? Okay, we went all the way up to 17 rand. So we're talking about a drop in buying power of roughly about 47%. Okay, that was the whole Nelligate story. Okay, we know what happened in December. Three finance ministers in one weekend. So that's what happened there. That's negative sentiment, and that's what we kept up. That's all bearish. And since then, you can see the market has recovered a bit, and we had this little rally again, and then this breakout. This is the two oscillators, RSI and stochastic. They're saying we're overvalued, we're overbought. And then that's where this pullback. So this looks opposite to a share. When this goes up, it's bad. When it goes back, it's getting better. So we're talking about rand strength. So you can see the trend at the moment. We're breaking below a 50-day moving average. That's the red line, and we're very close to a 200-day. But long-term trend, we're still looking at bearish. Okay, so that's a bit of an introduction. And when I looked at last, this was a quarter 12. The rand was trading at 14 rand 91, which is a good pullback. And then remember, since that high of 17 rand, we pulled back to about 15 rand, and then we had this little rally. And then, as I say, we're trading at 14 rand at the moment. So long term, we're still looking at rand weakness. In the short term, now obviously rand strength. So that's the current situation. What does that translate into? And there's two scenarios, and I'm going to take it from a perspective of investor. I can look at, let me just take this out of the way. I can look at a stronger rand, and there's pros and cons. A strong rand, or it's not all bad, okay? But also not all good. So we talk about a strong rand and a weak rand, but also on the highlight here, top here, we're looking at a competitive rand. That's what we want. We want a competitive rand. So a strong rand, as I say, it's not good, it's not bad. So goods produced here in South Africa will be more expensive for foreigners. So obviously, our tourists come here and our rand gets stronger, things will be a bit more expensive for them. However, our exports also are less competitive. But on the other side of the coin, our imports are relatively cheaper, especially when it comes to commodities and fuel. Fuel's our biggest import. So when the rand gets stronger, it's great because it helps us with our fuel imports and ultimately lower petrol prices at the petrol station, and the implication there is hopefully they will keep, well, inflation will be under control and interest rates will get lower. So that's the one side of the coin. The other side of the coin, we talk about a weaker rand. Now, as an investor, what would you do with a weaker rand environment? You want to buy into shares that are export orientated. They're exporting goods from South Africa offshore, and we're competing on a global stage, in a global village, number one. Or you want to buy into companies that have international operations. So these are usually the dual listed companies listed here and overseas. For example, Anglo's is listed here and on the London Stock Exchange, and those kind of things you want to take advantage of. Thirdly, you might want to defend yourself and buy into gold, because remember, gold is still dollar based. So as the rand gets weaker, you're protecting yourself on that side. However, remember, if the gold price falls, you're losing out on that side. You want to be in a situation where you want to avoid debt investments like the bonds. Remember, we're talking about risk instruments here, and obviously, if the rand gets weaker, the implications of inflation and ultimately rising interest rates. So you want to avoid that scenario. And then what's more important, and this is where we lead into our presentation today, you want to trade directly in appreciating currencies. So how do we do that? So what is our ideal situation? So the ideal situation, well, how do I take advantage of that, is what I call being in a situation where, and some of you might have heard of it before, a Goldilocks economy. Now, the definition of a Goldilocks economy is an economy that is not too hot, that it causes inflation, and not too cold, that causes a recession. Okay, so this is the ideal situation you want to be. So there's no exact markers for a Goldilocks economy, but there are certain characteristics that we look at. Number one, ideally we want a low unemployment rate. Secondly, what's important, you want a scenario where we have increasing asset prices. So the share market's going up, property prices are going up, and those kind of things. That's the second scenario. Low interest rate environment, we have a brisk but steady GDP growth. So the economy is ticking over at a brisk pace. But we also have a scenario where we have low inflation. So put into a nutshell, we have positive sentiment, there's growth. That's what I call a Goldilocks economy. Okay, if you remember the Goldilocks and the Three Bears. So this is ideal for investing. That state is ideal for investing because the companies are growing, the share market, the JSE is growing, everything's performing well, and in the absence of inflation, okay, obviously bonds also hold their value. So the challenge is, and we talk about business cycles. And for example, business cycles vary in intensity and duration. For example, the US economy goes through 5 phases. They go from a growth or expansion phase into a peak, or a top, and then we go into a recession or contraction phase, and then we bottom out to a trough, and then we go into recovery. Now, a Goldilocks economy focuses on that a recovery and growth phase. So this is a scenario where if we have a competitive rand. Okay, so that'll translate obviously into well, I like to think of it's going to translate into a Goldilocks economy. But the thing is, as I say, you want to take advantage of it. And that's what we're going to talk about today. So how do we get there? So I'm going to talk about currency futures today. So what are currency futures? How can we use them? And as a trader or as an investor, and benefit from it. So first of all, some background. The JSE introduced currency futures way back in 2007. So the whole idea with currency futures, and we're not talking about spot forex trading like you see on TV and things like that. We're not talking about trading the dollar relative to the euro. We're talking about currency futures. It's a JSE regulated product. The main thing, the big difference between the two of them is that the performance by the counterparties is guaranteed. Okay, by SAFCOM, which is the JSE clearinghouse. So something goes wrong, it gives you that peace of mind. I can go to the JSE, I can go to the Financial Services Board and say, okay, this is what happened. You got a bit of a recourse. That's a big thing when it comes to peace of mind. But what are currency futures? Bottom line, enables you as a trader to exchange one currency for another, the rand for dollar, rand for euro, at a specified date. Remember, this is a future we're talking about, at a price fixed on at the purchase date. Okay, so that's in a broad nutshell what is a currency future. But I'll go into more detail with it now. Okay. So the main idea here is that it allows us as local traders to gain exposure to foreign currency movements. So remember, it's relative to the rand. It does not affect your offshore allowance. So you can make money while the currencies are going up and down. That's what we're talking about here today. So currency futures, obviously futures will give you the clue there. It's a geared product. You don't need to put on 100%. You need to put on a deposit or initial margin, enough to cover the cash, okay, to cover the initial margin. So your gearing is 10 times. I'm putting down 10 rand to have 10% to have 100% exposure. My gearing is 10 times. As I said just now, we're taking advantage of the currencies moving up or down. So we're talking about going long and we're going short. So remember, it's always from the foreign currency to the South African rand. So we're either going to buy the dollar or sell the rand. That's if I'm anticipating that the rand's going to get weaker, or I'm anticipating the rand to get stronger. I'll sell the dollar and buy the rand. So remember, it's always from the foreign currency point of view. The contract size of a currency future is 1,000 of the underlying foreign currency. So it's $1,000, 1,000 euros, 1,000 pounds. Okay, that's number one. Number two is that it's very low trading costs. It's going to cost you 20 rand for the purchasing legs. That's including the VAT. So in and out the market, 20 rand in, 20 rand out, so 40 rand. So the share, the currency future has to move 4 cents for you to break even. So we talk about each movement, we talk about pips. So the rand is quoted in 4 decimal points. And I said you just now 14 rand 91.57. That is the 4 decimal points. So each 1 cent movement is equal to 10 rand in profit with the future. The profit or loss, by the way. So remember, 4 cents, 2 cents in, 2 cents out, and you broke it even on cost. The main thing, as I say here, it's cash settled, so we don't ever convert back into dollars, bring back dollars. It's always settled in rand. So those are some of the background information around a currency future. So how do we get started? How do they work? You'll open up a currency futures account online. Do the whole FICA thing. Once the account is opened, you need to deposit an initial margin. Okay, and that initial margin gets ring fenced. So it's a deposit you put at the JSE. And then you decide, are we going long or short? It depends on what currency you want to trade. But there's three things you need to understand. We talk about mark to market, and this is where derivatives are different to normal underlying shares and things like that. The definition of mark to market is a daily revaluation of each open position at the close of each business day. So if I bought something at 10 Rand, now it's moved up to 10 Rand 50, that 50 cents, the difference will be put in your account tonight. Okay, you can take that money tomorrow and trade more. Remember, I said you put roughly about 10% in a deposit or initial margin. It gets ring fenced. You need to keep it at 10% or 10% on a daily basis. If the market goes against you, so remember when I say gearing or leverage, it's a double-edged sword. If the market goes against you, that 1 Rand will be taken out of your account tonight. You need to top up. Okay? So that topping up is what we call variation margin. It's a daily process through which the unrealized profits and losses are processed into your account. And you'll get a margin call if you haven't got the cash in your account. We're talking about futures here, so they have a life expiry. So they trade on a quarterly basis. The third Tuesday of every quarter, we have a futures closeout on currency futures. You'll be alerted with email when these contracts will be changing and things like that. But the third Tuesday of March, June, September, and December will roll over. So you can either roll over. The default position is we automatically roll over to the next position. So you can also close them out. You can close them out whenever you want to. Okay. So here's a little case study, just to try and make it a bit more realistic. Sizwe, he's very optimistic. He's optimistic about life in general. But he's optimistic that the current economic climate is a lot of positive sentiment around. He feels that we'll start seeing a more risk-on environment, people moving out of the dollar and more into emerging markets and that kind of stuff. He also feels that the rand is undervalued and should appreciate in the near future. So that is the context. Okay. So on day one, the spot price was trading at 15 Rand 08 cents. Okay, there's those four decimal points I was talking about. The futures price will be trading slightly bit higher. Why? Because there's interest in it. Okay. So remember, I'm anticipating the rand to get stronger. So our sell in this situation, since he sells, he wants about 10 contracts. He sell, and this is how the code. It'd be ZAUS contract. So this will be trading at the moment in the June contract. You'll see on our website there's a September contract and a December contract also available for you. So he goes and sells 10 contracts, okay, at the futures price. So his exposure is 10 contracts, 10 times the underlying, 1,000 times that is 154,351 Rand. His initial margin in this scenario, and you'll see a slide just now, I'll show you all the other different margins. The margin for the dollar contract right now is 1,450 Rand per contract. He's buying 10 contracts, so he's putting down 14,500 Rand to have exposure of 154. Can you see roughly is about at 10%? Okay. Remember I said brokerage is 20 Rand per contract. So in this situation, his purchasing leg is 200 Rand. Okay, 20 times 10 contracts is 200 Rand. So he transfers over to PSG will take 14,700 Rand. That's the initial margin plus the brokerage. That will be ring fenced and you're earning interest on that money. Yeah, so that's on day one. You'll see I've got a cash flow table just now shows you this whole story in a better detail. On day four, okay, remember I'm anticipating the market the rand to get stronger. So the rand has pulled back. You can see there's still that differences between the two of them because of the interest. So if I sold, I buy back now my 10 contracts. So I buy back at the futures price, 14.98. In this situation, my gross profit is 4,503 Rand. How's that calculated? It's the difference where I got in and where I got out. Okay, it's 45 cents times 1,000 times my 10 contracts. My brokerage is 400 Rand. Okay, because remember, in and out the market, it'll be 200 Rand on the closing leg. So in and out the market, my net profit was 4,103 Rand. So what does that translate into? I put down 14,500 Rand and I make a profit of 4,103 Rand. So that's a return of 28.3% in talking about 4 days. In that same period, the Rand only strengthened by 3%. Can you see how the gearing works with currency futures? Okay. So hopefully on the next slide, it'll make more sense to you. Exactly the same scenario we spoke to just now. So on day one, I got 10 contracts, 14.50 a contract. So that's my cash flow out just on initial margin. My brokerage, 10 times 20 Rand is 200 Rand. That's the price I traded at. At the end of the day, that's what it closed. So the profit on that particular day, I made a whole 2,000 Rand. But net cash flow with my initial margin and the brokerage, 12,000 Rand went out of my account. The next 2 days, you can see the closing price. The mark to market would have been my so-called closing price. It would be my next day's opening price. There, the market pulled back again, so the Rand strengthened more. In that scenario, I made strengthened roughly about 8 cents. And by the way, the market's been trading between 30 and 50 cents on a daily basis. That's the spread we're talking about. So there we made 845 Rand. The next day, however, the Rand weakened. We dropped from 15.15 and the Rand dropped 20 cents. Okay, the Rand weakened 20 cents. And that's scenario, 2,000 Rand went out of our account. Remember that 2 Rand, 20 cents times my 1,000 and my contracts was 2,000 Rand. So there's my money went out of my account. I would have had a margin call to top up again. Okay, if I didn't have the cash available. And on day 4, I close out in 14.92 and I get my margin back. There's my brokerage. But if you had to add all this up and subtract the negatives, you would come to 4,103 Rand. Okay, so that gives you a bit more explanation how that case study would have worked. Okay, so I hope that makes sense to you guys. What does this all mean? What's the benefits of currency futures to you? First of all, it's a very cost-effective way to gain exposure to currency markets. Remember, you do not utilize your offshore allowance, so you can still take advantage of Rand movements. The currency futures market is characteristically liquid and easily traded. But saying that, I must say I would suggest trading the euro, the dollar, and the pound. Those are the 3 most liquid markets. Okay, the others are becoming more and more liquid, but I suggest stick those 3. They're very capital efficient. Remember, you're putting down 10% to have 100% gearing, 100% exposure. So they're very capital efficient. Remember, you can sell futures. You can benefit from a depreciating currency. Again, remember, it's from the foreign currency point of view. Pricing is transparent. And remember, I said also that the difference between the spot and the futures price, we're using whole interest rates. That's 7% per annum, roughly about 7% per annum. That's what you've been charged there. Bring down 10% and I'm borrowing the other 90%. It's going to cost me roughly about 7% per annum. Remember, peace of mind. It's exchange regulated and guaranteed by the JSE. And you have DMA, direct market access. So what you're seeing on our platform is you trade directly on the JSE's platform. PSG does not add anything to the ruling bid or offer spreads. Okay, so that's clean, direct market access. So those are some of the benefits to you as a trader. Just quickly, before we get into some of the other consideration, I came across this website of Investopedia. And these are 8 tricks for the successful currency trader. And you can put this as equity or single stock futures. I use the same scenario, 8 steps, to find your goals and then choose a style. My goal as a trader is to be consistently profitable. That's my overall goal. My style, I must say I'm more of a position trader. So that's the time duration. And sometimes I might be a swing trader. Obviously, with currency futures, you've got 90 days between swing trading and position trading. Some of you might say it's too risky to hold a position overnight. You want to do some day trading. You just trade more contracts intraday. Choose a methodology. I've spoken about this before. I like breakout trading. You saw that graph just down the Rand, breaking below a support trend line. That's what you're getting to the market. But be consistent in this application. That's the main trick here. As I say, please refer back to this link here. Goes into more detail. What I find useful also is look at the longer term time frame. So look at your weekly charts, give you direction analysis, and your shorter time period to get you in and out the market. And obviously, you want both time durations to be the same. If it's overbought on the weekly chart, you want to be overbought on the daily chart. Calculate your expectancy. This is one of the ratios you would use. Calculate if you do 10 trades, how many of them are winners, how many of them are losers. So example, 10 trades, 6 of them are winners, 4 of them were losers. You'll calculate what's my winnings. So every time I do a trade, those 6 trades equal to, say, 24,000. You'll calculate the ratio between the 2 of them. So you want to calculate every time I put on the trade, what is my expectancy of making profits. Okay, but going to more detail, go to the website, goes into more detail, and it gives a nice little formula there for you. Focus on your trades, learn to love small losses. So yeah, it's part of the process. You have to learn losses, manage those losses, very important. Feedback loops, the main thing there is success breeds success. Okay, so I like to keep a trader's journal. I write down the reason for buying or into a trade, and I learn from the experience. And what I learned also with comes to currency futures, perform weekend analysis. So there's websites for it. There's forex calendars, events calendars. The week ahead, which important economic events are coming up? U.S. inflation, U.S. Unemployment, all those kind of things will affect the dollar, will affect the rand. Okay, so be aware of those kind of things and have a view. If this happens, that's what's going to happen. And obviously, you want to act on that. So find a good website. There are numerous websites you can use in that scenario. Keep a printed record. This is obviously a learning tool. I like to use it as a learning tool, and ideas like a funnel to make less and less mistakes. So yeah, that's just a quick aside before we get into some questions you guys might have. So what currency pairs can I trade? There are 7 on our website. As I suggest, the top 3. There's the contract, the code, ZA, US, ZA, EU, ZA, GB. Those are the pound, euro, Aussie dollar, Japanese yen, Canadian dollar, and Swiss franc. This here, for example, is the margin required right now for the June contract. You go into our website under indices and click on currency future on single stock futures. You'll find the list. You'll find the September margin as well as the December margin. Okay, so that's an example of the margin requirements. So it's roughly about 10 to 20% of the exposure that you need. Who trade currency futures? It falls into 2 categories. You'll get the hedgers and you get the speculators or the traders. The hedgers is someone who wants to hedge or insure the risk. So, for example, a farmer or a manufacturer that wants to import some machinery from France, for example, you would buy the euro contract to hedge against a weakening rand. That's one scenario. If the Sasol, okay, you're a Sasol shareholder, and you're worried about the rand getting stronger, obviously will impact on the Sasol's earnings. So you'd sell the dollar to protect yourself against rand strength. I hope that makes sense to you guys. So this is some examples on the hedging side. Speculators are someone who wants to take advantage of a situation. For example, a pound is overvalued, ready to turn around. I would decide to sell the pound contract, obviously to benefit from the move when it takes place. So those are the players in the market. So you'll be either a hedger or a speculator, or be both. Okay. What are the risks? Now you must understand when it comes to derivative trading, there are risks involved. So I'm just highlighting it for you. Each currency future trade is unique and comes with its own associated risks. This last week alone shows you importance of interest rate risk and things like that. And if we're downgraded, what would have happened? But be aware of volatility. That's why I asked you right in the beginning, who's worried about volatility? Exchange rate risk, credit risk, monetary risk. So an experienced trader will evaluate all those variables. So one thing I've learned over the years, I look at fundamentals. Okay, that will help me for the long-term trend, and I use technicals for short-term, but I use both together. Okay, so just to highlight for you guys that yes, there are risks involved. It's a good instrument. As I mentioned right in the beginning, it's a double-edged sword. You can make money when it's in your favor. It can also go against you. You can lose your margin, and you have to top up, so it can cost you more than your initial deposit. So just be aware of those kind of things. But also understand that currency futures is not for everyone. You need a high appetite for risk. You need time to watch the markets. You need expert knowledge of, number one, the currency markets, and number two, the associated trading processes. So as I say, it's not for everyone. So you need to consider carefully whether trading currency futures is suitable for you in light of your circumstances and obviously your financial resources. So just take that into consideration. Okay, there's a quote from Albert Einstein. Now, this is a quote that I put in, but I want to just adapt it slightly, where we're looking at a famous quote from Albert Einstein: a person who never made a mistake never tried anything new. So those of you who have never tried currency futures before, you think, oh, it's risky. we're talking about initial margin. That's what we're talking about. 1,460 Rand, let's round off to 2,000 Rand. That's what you're risking initially just to wet your feet. But the way to look at this, and as I adapted it for trading, a trader who has never lost is not a trader yet. So yes, you can simulate the market with paper trading. One way to get really started and gain experience fast is with real money. Okay, so I hope that little quote makes sense to you. So let's look at the questions you guys might have. Okay, where's my questions? Cool. Clearly, specific. Okay, lost audio. Oh man, I don't know why you guys have lost audio now. I can hear you fine. Lost audio. So a bit of, some people have lost audio. Something. Got audio. Okay, so some of you got audio, some haven't got audio. I got an idea. Sorry, guys. Are there any questions? You can hear me. Thanks, Doc. Dr. Yuen, I can hear you clearly. Great. There's a question from Ellen. Where does the gearing come from? Ellen, remember I'm putting down initial deposits like buying a house. I'm putting down an initial deposit of 10% and I'm borrowing the other 90% from the bank. That gearing. My own money is 10%, but the 90% is geared. It's borrowed. So I hope that answers your question. Poor audio again. Okay, guys, I'm sorry about the audio. I've got no idea why it would be coming and going. Okay. Like, are there any other questions? I don't know. I hope that made sense to you. So all derivative products are geared or leveraged. Yeah, Gareth, I agree with you. Your statement, using these futures intelligently requires some training. Yes, I agree with you. So as long as you understand what the product is, first of all, how it works, the contract requirements, that's number one. And number two, if you understand gearing, it works in your favor if you understand how it works. Okay, Alan, pleasure. So Gareth, yeah, and I suggest, you can start off with a simulated trade, in the sense that you do an Excel spreadsheet and say, what if I go long or go short in the scenario, what would happen? So yes, that's how you'll gain some experiences. Yes, Carlo is a good question from Carlo. Are there any ETFs in currencies? Yes, well, they're not ETFs. They'd be called ETNs, exchange traded notes. And I think Standard Bank have arranged with them, but you can trade them as normal shares, having exposure to those different currencies. But to answer your question, Carlo, yes, you can have exposure through ETFs also, more specifically ETNs. Are there any other questions? Pleasure, Carlo. Looks like that's all the questions. Awesome. Oh, here's another question. Rainy, does PSG offer service where one of your asset managers trade on behalf of the investor? The investor gave 100,000 for a period and you trade as good as possible. Yes. You can trade through any of the financial advisors, through the stockbroking offices and things like that. Yeah, so give us a call and I'll put you into contact with the closest closest financial advisor to you, Rainy. By the way, and thanks for bringing it up. Let me just get rid of this. Need to bring up my conclusion quickly. So just what I want you to gain from this presentation. Currency futures are geared products. So there's that initial margin. Everybody understands the initial deposit. That's no problem. The risk comes in understanding how variation margin works, that top up. So on a daily basis, you'll get a margin call if the market goes against you. So that's number one. Number two is, remember, currency futures are low trading costs, only 20 Rand per leg. By the way, I forgot to mention, if it's a day trade, if I buy and sell in the same day, I only pay the 20 Rand on the one leg. Okay, so the JSE is trying to encourage more day trading. So just be aware of that. For the day trade, you only pay for the purchasing leg of the transaction. Currency futures are transparent and there are tight spreads between the bids and offers. Okay, and that's becoming more and more popular with the traders. So, what's your next steps? So if you want to get know more about currency futures, go onto our website, click on that link. Takes you to our currency futures website, gives you more information. If you open up a currency futures account, you also have access to our trading desk, our private traders, Tian Hadenrich. You gladly help you with putting on your first trade. He can't tell you specifically what to trade, but he'll help you with the execution and that kind of stuff. So you have that peace of mind that there's someone to hold your hand with your first trade. If you haven't got any other questions, you're welcome to drop our client services an email, as well as there's our toll-free number. But from my side, there's 2 more webinars coming up this month. Next week, we're talking about trading all the index futures, and the week after that, how to trade or how to hedge yourself using single stock futures. Okay. But from my side, guys, thanks a lot for being on this webinar again, taking out your time, your busy schedule for being here. Thanks for your support. I really appreciate it. There's my contact details, my email address. You're welcome to drop us an email. And if I haven't answered your question, yeah. Okay. Looks like there's some more questions coming in here quickly. Sorry, Russell. If you buy, do you sell a specific trade that you bought, or do you just sell? Yeah, remember we're trading currency pairs. So currency pairs, you decide what side of the trade you want to be on. Remember, it's always from the foreign currency point of view. So I anticipate the rand to get stronger. Okay, I would sell the dollar. If I anticipate the rand to get weaker, I'd buy the dollar. Okay, so and then obviously when you close out, you just do the opposite. I hope that makes sense, Russell. But great, thanks for your question. Guys, from my side, thanks a lot. I hope this was beneficial. You've learned something today. Until next week, all the best. Bye for now.